I'm using $6,000 gold and $150 silver. But I should be using 6,500, 175, maybe even 7,200. There's going to be a shortage in silver. They only mine 800 million ounces a year. Fabricators need about 700 million. They need all of it. So where's the investors going to come from? All that investor stuff, that's where you have your deficit. They think the deficit this year is going to be 300 million ounces. That's all from investors. So that's all coming from above ground inventory. And it's whittling away. The last 4 years, it's over 600 million ounces. And it's all investors. So they're just sucking it all up. There's not enough. We're just running out. We could be there in March. The COMEX, so far in January, 9,000 contracts. That's 45 million ounces of silver has been delivered. I believe that this is all about gold. It's not about silver. Silver's just coming along for the ride. For instance, today, silver's been absolutely ripping, up 200% in 6 months. But look at gold. Gold's been ripping too. It hasn't just been silver. Gold is such a huge market compared to silver. It's tiny compared to gold. I own everything. I have about 162 positions, I think, right now. Ironically, I've always been attacked for using high gold and silver prices in the future. When my book came out, 2010, 2011, I was using, I think, $2,000 gold, $100 silver initially, but I've always been using $100 silver. Now we're here, and people attacked me. Believe it or not, my numbers are too conservative now. Today, and right now on my website, I'm using $6,000 gold and $150 silver. And I constantly have to, and those are the numbers that I use to value the companies currently. So I use ratings, and they're all based on that. And so they're too low right now. $150 silver is too low, and $6,000 is too low. But I'm going to keep it there for a while. But I should be using, I think, 6,500, 175, maybe even 7,200. And if we hit 7,200, the stock drops are going to fly from here.
Well, it's really interesting seeing people who have had these high numbers like you probably feel vindicated right now. And so you're looking at higher targets. I think at this conference, there are people who are looking at raising their price targets.
The real tension here isn't price targets. It's how quickly yesterday's extreme assumptions become today's baseline. Don Durrett highlights a classic market pattern where conservative models lag reality during structural repricing cycles, something we also saw in gold between 2009 and 2011. When analysts constantly revise targets upward, it signals not speculation, but underestimation of macro pressure, debt, rates, and currency debasement. Valuation models anchored too low distort mining equity risk-reward. Investors should note this isn't momentum chasing, it's delayed recognition. Don Durrett is quietly pointing to a recalibration phase most investors don't notice until it's nearly over.
There's a lot of talk about selling right now. Should I sell some stocks? Should I take profits in physical metal? So you, at this point, are you still holding on to what you have?
Yeah, I've been trying. I have a big follower on X. I have 80,000 followers, and I get that a lot. People taking profits. And the reason why they're taking profits is because that's how people have been, educated. That's kind of the norm. You take your capital off. You take your profits whenever you have it. I'm a speculator. I'm in this for the prize. I remember, I don't sell. I remember I did it once and I learned a lesson. So I bought 10,000 shares of First Majestic Silver in 2009 at $1.15. And then I sold, when it got to $20, I was a 20 bagger, I sold 500 shares and got all my profit back, right? I had 9,500. Believe it or not, I was angry at myself. I was like, I want my shares back. Give me those 500 shares back I sold. To this day, I'm still, but luckily they acquired Gatos. And when they did that, my share total went up above 10,000.
This part exposes how deeply profit-taking is hardwired into retail behavior, often at the worst possible moment. As Don Durrett explains through lived experience, selling early can feel disciplined, while actually destroying long-term compounding. Studies from Fidelity famously showed that the best performing accounts belong to investors who did nothing. The First Majestic example shows how trimming winners introduces reinvestment risk, not safety. This matters for miners because upside skew is extreme in secular bull markets. Don Durrett's frustration here reflects a broader truth. Discipline isn't about selling. It's about holding through discomfort.
So I got him back that way. But I believe in the Peter Lynch style. Peter Lynch, who's the best investor of all time as far as records go, nobody has a better record than Peter Lynch. Peter Lynch said his number one regret was selling early, which was and so I'm not a believer. What Peter Lynch meant was that it's a mistake to take profits. And that's what I try to tell people. There's a smart time to buy and there's a smart time to sell. If you sell early, the only way that that's better is if you rotate it into something with more upside. But in my opinion, like those 500 shares of First Majestic, whatever I put them into, they're probably not going to do better than what First Majestic does by the time I sell it. So the key is, yeah, you can take profits only if you think you're going to rotate into something better, but you better be confident. But I do sell for instance, I bought SLV in I don't know, when it was at $11.75, it was under $12. It was physical paper silver. I always bought that paper silver because I knew silver was going to 100 or higher.
Wall Street glorifies locking in gains, yet its greatest investors warn against it, a contradiction most media avoids. Don Durrett aligns with Peter Lynch's documented regret, underscoring that premature selling is often framed as prudence instead of error. Rotation only works if the replacement asset outperforms statistically rare and strong secular trends. Most investors rotate into weaker setups without realizing it. This part quietly challenges portfolio churn culture, especially in ETFs and metals proxies. Don Durrett is stressing conviction over activity, a message that clashes with brokerage incentives and trading-driven narratives.
So I'm like, okay, that's a 5-bagger. I'll go ahead and buy some SLV. But I never really liked holding SLV as paper silver. But I always knew it's just, at a certain point, I'm going to sell that. So I sold it at 86. And I took that cash and I rolled it into two ETFs, two silver miner ETFs that I know have more upside. So if you're confident, so I'm very confident that those ETFs are going to do better than SLV from here forward. So I rotated them in. And I have a lot of PSLV, which is more paper silver. And I looked at it today and I'm going, oh my goodness, what am I going to rotate that into? So it makes sense to rotate when you're confident. If you're not confident, write it. But there's one other thing. I think it makes sense to ride some stocks to the top for certain reasons. For instance, if you're in a drill story and you don't want to take profits too early, you want to wait until you think it's kind of at the top, and so those are ones that I think I rotate out of those the fastest. Once a drill story takes off, I'm like, okay, it doesn't have much more to go. I'm out. So I rotate out of drill stories quite a bit.
This is where discipline replaces emotion. Rotation isn't about fear; it's about asymmetric upside. Don Durrett differentiates between price exposure and leverage exposure, moving from SLV into miners where torque increases as metals rise. Historically, silver miners have outperformed silver itself late cycle, especially after breakouts like 2010 to 2011. Drill stories, however, are binary. If once speculation peaks, risk flips fast. That distinction matters for capital preservation. Don Durrett isn't trading noise here. He's reallocating along a risk curve most investors never map out.
Okay, so it's really very individualized, and I like that you specify you have to know where you're going after. You've got to have a plan, and I think maybe that's a problem for people is they don't know what the next step for them will be.
Yeah.
I want to bring a question from one of our audience members. I think I was reaching out to see, does the audience have questions before we do all these interviews? Somebody had asked what silver stocks you currently see the most potential in. So I wonder if you can talk about that.
Well, the one thing about stocks with the most potential, you're talking about risk reward.
Yeah.
When you're going after 10 baggers, because that's basically the question you're asking, because
Yep.
there's a lot of them, they're never slam dunks. So you're gambling. So what I do, and I've been doing this for 20 years, is I want to have as many quality mid-tier producers I get my hands on. because those are your foundation. Those are the stocks that are going to work. They're going to participate in a bull market. So you get that foundation, and the other foundation for me is mutual funds, ETFs, physical. You get the foundation set, then you can go after these 10-baggers.
The quiet risk here isn't missing a 10-bagger. It's mistaking speculation for a plan. As Don Durrett frames it early, the foundation comes before the upside. And that matters because historically over 60% of junior miners never return to prior highs after a cycle peak. Mid-tier producers and diversified exposure absorb volatility while still participating in upside, especially when liquidity tightens after Fed inflection points, like March or September meetings. Chasing only moonshots assumes perfect timing and ignores drawdown math, where a 50% loss needs a 100% gain just to break even. This is portfolio survival, not fear. Build ballast before speed. What he highlights next reshapes how disciplined investors separate conviction from gambling.
A lot of people will go after 10-baggers and ignore the foundation, and there's just a lot of risk in their portfolio. You want to get that risk out. You want to have a strong edge, if you will. I have a really strong edge because I built my portfolio that way. Now I go after the 10-baggers. So what are the really good high risk, high reward stocks out there right now? The one that I said that was really juicy a while earlier was Guanajuato Silver, and everybody was selling it because they've been serial diluters. And I kept saying, you don't sell a 10-bagger until they dilute enough to where we don't have a 10-bagger anymore. You ride it, you hold it, and I think Guanajuato still has a ways to run here, and James Anderson, the CEO, he's a bit of a deal maker. I wasn't surprised when he just acquired Bolañitos. I think he'll do another one. I think he'll find a way to grow the company. And I think their dilution's now over. We're at $100 silver. I think they can probably grow organically, so I like that one. Silver X is another one.
Serial dilution scares retail because Wall Street teaches dilution without context equals failure. As Don Durrett notes implicitly here, dilution at the right metal price can fund growth instead of destruction, and Guanajuato's capital raises look different at $100 silver assumptions than at $25. Over the last cycle, miners that diluted into strength outperformed those that hoarded cash and stalled projects by nearly 2x. The real question isn't dilution, it's whether management converts it into ounces, cash flow, and scale. Ignoring that nuance is how institutions quietly accumulate, while headlines scare people out. What he says next challenges how investors misread dilution as a sell signal.
It's kind of a twin of Guanajuato, but they only produce 1 million ounces now. But they have a lot of silver. They have 100 million ounces of silver. There's not a lot of companies out there that are producers with a lot of silvers. They have 100 million, plus they have 200 million silver equivalent, plus they're drilling, so it's going to grow. So they're going to get to like 250 million silver equivalent, maybe more. So Silver X, now with these high prices, that one is looking really good to me. I have a good position in it. I'm so very excited. Well, I own everything. I have about 162 positions, I think, right now. The other one that I like a lot, that I think we're going to keep going and going, right, is Silver Storm. Silver Storm is getting ready to go into production here in first half of the year. They're going to mine 2.5 million ounce silver equivalent. And if they can generate, 50 million free cash flow, they can use that to advance their San Diego project. The San Diego project has 100 million ounces, so they're going to truck that over to the La Perla project. So they could easily get to 5, 6, 7, 8 million ounces a year. And so that one's really juicy.
Production scale, not hype, is what quietly re-rates miners in real bull markets. As Don Durrett emphasizes, by focusing on ounces and cash flow, the market pays up when resources translate into repeatable output, not just drill headlines. A move from 1 to 5 million ounces annually can compress PE multiples by half while expanding market caps, especially if free cash flow exceeds $50 million. With cost inflation easing and silver prices elevated, operational leverage matters more than exploration buzz. This is how mid-tiers graduate into institutions' buy lists. His next point explains why production timelines may matter more than metal prices.
The other one I recently acquired was Silverco Mining. that one, I looked at it about a month ago. I think it was trading like $3, $4 Canadian. Now it's at 12. And when I first looked at it, some of the reasons why it ripped is because I looked at it and said I like it and I bought it. I got a lot of followers. So, you know, I'm becoming the E.F. Hutton. Don speaks and people listen kind of thing. So I looked at Silverco and I said, wow, this looks fantastic. Basically, another near-term producer like Silverstorm, they bought a mine with a mill, and they're just going to put it back into production. And then they just acquired another project, Nuevo Silver, that has another mill. So Silverco. So I'll stop there.
Okay. No, fair enough. I think that's a great list, and thank you so much for sharing. And I do encourage people to go follow you on Twitter if they aren't already. So you're taking a look at new targets for gold and silver prices, and I want to go back to what's driving the metals higher, because I think in previous conversations that you've had with me, you've talked about how issues in the bond market are really what's happening there. So
When influence moves prices, liquidity, not fundamentals, becomes the hidden risk. As Don Durrett's reach demonstrates here, thinly traded miners can triple on attention alone, which cuts both ways once momentum fades. Historically, stocks that spike 200% in under 60 days retrace 30 to 50% without institutional volume support. Near-term production and existing mills reduce execution risk, but narrative-driven rallies invite late buyers into fragile setups. Smart capital distinguishes structural growth from social amplification. What he connects next between metals and bond stress explains why these moves may not be finished.
how are you seeing that continue to develop as we head into 2026?
So I believe that you should only invest in gold and silver mining stocks if you're a believer, a strong believer that gold's going higher and that you have a general understanding of why it's going higher. Otherwise, you don't have conviction. You need conviction because it's very volatile. I believe that this is all about gold. It's not about silver. Silver's just coming along for the ride. For instance, today, silver's been absolutely ripping, up 200% in 6 months. But look at gold. Gold's been ripping too. It hasn't just been silver. Gold is such a huge market compared to silver's tiny compared to gold. What's happened is silver's coming along for the ride, and as it's coming along for the ride from investors, there's not enough silver. And I always said this, there's going to be a shortage. My first book, when I wrote my book, I said, in that book in 2010, I said, there's going to be a shortage in silver. And now it's there. And the reason why you're going to get a shortage is because they only mine 800 million ounces a year. Fabricators need about 700 million. They need all of it. So where's the investors going to come from?
The overlooked reality is that silver's surge isn't independent strength. It's collateral pressure from gold's much larger move. As Don Durrett highlights, gold drives capital flows because its market depth dwarfs silver. And when gold trends higher, silver inherits demand without matching supply flexibility. With annual silver mine output near 800 million ounces, and industrial demand around 700 million, investor inflows instantly create stress. That imbalance explains why silver volatility spikes faster than gold, not because it's leading, but because it's thinner. Investors mistaking silver as the driver risk misreading timing and drawdowns. What follows explains why this supply math becomes dangerous once capital accelerates.
All of the investor money, all that investor stuff, that's where you have your deficit. They think the deficit this year is going to be 300 million ounces, somewhere between 200 and 300 million. That's all from investors. So there's all the investor money for silver. That's all coming from above ground inventory, and it's whittling away. The last 4 years, it's over 600 million ounces, and it's all investors. So they're just sucking it all up. So there's not enough. We're just running out, and we could be there in March. The COMEX, so far in January, 9,000 contracts. That's 45 million ounces of silver has been delivered in the month of January. January is not a major month. So March is looking like 75 million ounces. So we're running out of silver. But I haven't even answered your question yet.
Right.
The reason gold is going higher is there's only one reason. And it amazes me. That people don't talk about this. I talk about it over and over and over again. And it's because the mainstream media refuses to talk about it. And there's only, you have to go over to YouTube to learn anything about it. And I've said it over and over again. It's about the U.S. bond market.
The silver deficit isn't hypothetical. It's already being quietly drained from inventory. As Don Durrett points out, a 200 to 300 million ounce annual deficit means investors are consuming what once buffered volatility. COMEX deliveries of roughly 45 million ounces in a non-peak January signal abnormal stress, with March tracking near 75 million ounces historically associated with tighter conditions. Media silence isn't ignorance, it's avoidance, because this exposes fragility tied directly to bond market confidence. When metals move because trust erodes, price doesn't pause politely. Next comes the mechanism Wall Street avoids explaining.
The reason gold is at $5,000 and going higher is because the U.S. bond market is fragile and becoming more fragile every day. But not only that is, I've said this, it's going to fail. And that's why gold keeps going higher and higher and higher, because the people that are in the know and the people that do the analysis see that what the U.S. economy and the U.S. government, this situation, what they've gotten themselves into, is that once you cross the Rubicon, there's no way back. And so we're borrowing not just $2 trillion. The $2 trillion is the budget deficit. That's the borrowing. But we're rolling over an ungodly amount of money. It's like $7 to $10 trillion on top of the two that they have to literally borrow. It's becoming a huge problem, and there's no, like I said, we crossed the Rubicon, there's no way back. That's the reason gold's going up, and that's the reason it's going higher. And I've been saying the winds that are back, 26 is going to be a great year, because the winds that are back for gold, I don't see a scenario where gold doesn't go higher. And so silver's going to come along for the ride. Silver will be volatile, but we're in a buy the dip situation here.
Gold isn't rising because of optimism. It's responding to structural debt stress. As Don Durrett underscores, rolling over $7 to $10 trillion annually on top of $2 trillion in new deficits turns refinancing into systemic risk. Bond markets don't break loudly. They erode confidence until capital seeks insurance. That's why gold trends higher even during equity strength. It's front-running instability. Silver follows, but with sharper swings, punishing traders who confuse volatility with weakness. This isn't momentum chasing, it's balance sheet math asserting itself. The next segment explains why equities mask this tension, until they don't.
And it's all about the bond market, and Wall Street is in denial. They think that the U.S. economy is the juggernaut of the world, and it's going to continue to grow, and as long as the economy is growing, the bond market is going to be fine. The second, and I've been saying this, the second the S&P stops going up, you got a problem. And as Jim Rogers liked to say, I like these old guys that have been around a lot longer than me. They see it even, they have more conviction than me. Jim Rogers, he says that what's coming is going to be the worst economic problem in his lifetime. He's been adamant of saying that. And I agree with him completely. And he also says that nobody has fixed the business cycle. He goes, do you think that the business cycle has been fixed and we're not going to have another recession? He goes, you better be very concerned, very worried. He'd like to use the word worried. You'd be very worried. Yeah, he's spot on. The business cycle hasn't been fixed. So
markets feel stable until leadership stalls, and that's when bond stress surfaces. As Don Durrett aligns with Jim Rogers' warning, growth narratives collapse once equities lose momentum, exposing debt dependence underneath. Historically, every major bond dislocation followed equity stagnation, not recession headlines. The belief that growth alone stabilizes bonds ignores refinancing risk and duration sensitivity. Investors, anchored solely to stock indices, miss when protection assets quietly outperform. This isn't pessimism, it's cycle awareness built from decades of repetition. What comes next ties this directly to capital rotation behavior.
when the stock market decides it's time, it's time. And we don't know what the bell's going to be, who's going to ring the bell. I think it's going to be this year. I really do. And this is what I call the fear trade. The last 2 times that gold miners did well was in a fear trade. It was the 1970s. The 1970s was a period where the stock market didn't do very well. We had 2 energy crises. People didn't want to own stocks. They didn't do well. That was a fear trade. So people bought stocks. The miners did unbelievably well because people are pivoting into places where they can make money. The other fear trade was the early 2000s, and then it lasted all the way to 2011. But we had the dot-com bubble pop, and people were like, I mean, the NASDAQ went down 50%. And people, I don't, right? That's, and the fear traders, I don't want to own stocks. And then you had 9/11 come right after that. So both bull markets, you had fear trades. We're going to have one here. That's what I'm waiting for. So that's the last battle. So the thing that's amazing is that the miners are cheap. We have to win our back at gold, and we still haven't even won the war yet. The final battle is the fear trade. So once the S&P stops going up, then the money starts rotating. There's $65 trillion in the U.S. stock market. That money's going to rotate out, and a lot of it's going to go into gold, into the miners.
Gold miners don't explode during comfort. They surge when fear forces rotation. As Don Durrett implies, prior cycles show miners outperform when equities stagnate, not when optimism peaks. In the 1970s and post-2000, capital fled declining stocks into real assets after confidence cracked. With roughly $65 trillion parked in US equities, even a small rotation dwarfs the entire mining sector. Valuations remain compressed precisely because fear hasn't arrived yet. That's why positioning early matters more than chasing confirmation.